Binding Private Ruling 227. It's a very, very interesting ruling. It's a share subscription transaction followed by 2 share repurchase transactions. It was issued on the 17th of March, deals with the Income Tax Act and more specifically determines the tax consequences of a share subscription transaction followed by 2 share repurchase transactions in terms of the Income Tax Act, capital gains tax, dividends tax, securities transfer tax, and it's valid for 3 years. So what I thought I'll do is I'll just explain who the applicants are and then explain the transaction by way of a schematical example, because that's just easier to follow. So what you have here, the parties to the application was the applicant, co-applicant, company A, co-applicant B, company B. The applicant intended to divest from A in order to manage its investment directly in B. So let's just put that into context. You'll see that we have on top here, we have the applicant who owns shares in company A, and company A in turn owns shares in company B. What the applicant wanted to do is it wanted to divest from A, so the middleman in my structure here. It wanted to divest from A. It wanted to hold shares directly in B. And to do that, it entered into a series of transactions. And the ruling is on the tax consequences of those transactions. But let me just explain the transactions that happened. So the applicant will borrow money from Bank A and will use some of its own funds to subscribe for shares directly in B. So the applicant transfers the funds it received from the bank to B in return for shares in B. B then uses that money to buy back its own shares which are held by A, so that A no longer owns shares in B. And A in turn uses that money to buy back the shares held by it in the applicant, and the applicant uses that money to pay back the bank. This is called inter-day funding. This transaction probably happened on the same day. The funds came into the account, journals were passed and out of the account on the same day or within a couple of days. And so what they achieved with this transaction is that the applicant owns shares directly in B, no longer in A, and it's paid back the bank. So that's how they entered into the transaction. And if we can just go through it again, for certainty and how the ruling explains it in words, is the applicant, so this is the company right at the top, will use the funding from Bank A plus its own funds to subscribe for equity shares in B. B will use the proceeds from the applicant on the subscription to enter into a share repurchase transaction to repurchase a number of equity shares held by A, the first repurchase transaction. A in turn will use the proceeds from B to enter into another share repurchase transaction for all the shares held by the applicant, the second repurchase transaction. And the applicant will use the proceeds from A to repay the bank. Now, portions of the proceeds received by A and the applicant will be applied as a return of capital. In other words, the buyback is funded out of CTC, contributed tax capital. And that's important for the definition of dividend and for paragraph 76 of the 8th schedule. But we'll just leave it there. The shares held by A in B, as well as the shares held by the applicant in A, were held for at least 3 years. In other words, we're in the deeming provision for section 9C. And the applicant subscribes for shares in B. So, right, let's look at what is the tax consequences. When the applicant, the first step, the applicant right at the top, subscribes for shares in B. The subscription price received by B will be contributed tax capital. The issue of shares by B to the applicant is not a disposal, hence no capital gains tax, and there's no securities transfer tax on the issue of shares to the applicant. So what are the tax consequences on the first repurchase? This is where B purchases a number of shares held by A in B. The consequences are: part of the proceeds received by A for the disposal of the shares in B will be deemed capital in nature by virtue of section 9C. The balance of the proceeds received by A will be regarded as a dividend. And you can look at the definition of dividend. It says any amount transferred or applied, including for the buyback of shares, is a dividend. So the balance of the proceeds received by A will be regarded as a dividend and included in gross income but exempt from tax under section 10(1)(k)(1). The repurchase of the equity shares from A by B will be regarded as a disposal of assets by A. The proceeds on that disposal, so of course A owns the shares in B and it's selling the shares back to B, so that's a disposal. That's a disposal for CGT purposes. But the proceeds will be reduced, for CGT purposes, will be reduced by the amount regarded to be a dividend and included in gross income of A. And why is that? Well, you look at paragraph 35 of the 8th schedule to the Act. It says proceeds must be reduced by any amount included in gross income. So even though it is exempt, the dividend, it is still included in gross income and therefore we reduce proceeds by that amount. No dividends tax will be payable in respect of the transaction, of course, as A is a company resident in South Africa, and there will be securities transfer tax on the disposal by A of the shares in B. So those are the consequences for the first repurchase transaction. Let's now look at the consequences for the second repurchase transaction. Repurchase of equity shares held by the applicant in A will be regarded as a disposal. The applicant is selling the shares it holds in A back to A. The proceeds will be reduced for the purpose of gross income by the amount regarded as dividend for the same reason as previously explained. No dividends tax because the applicant is a South African company. There will be securities transfer tax. This is quite an ingenious way in which to structure the divestment of the applicant in A, and very useful. You might want to look into that when you want to. It's almost like an unbundling transaction, very similar.